We all hear about how AI is revolutionizing finance, making markets faster, smarter, and more efficient. But what if I told you that the very technology celebrated as our financial savior is quietly setting the stage for the next global market meltdown? This isn't science fiction. It's happening right now, and most people have no idea. Stick with me, because what I'm about to reveal is the biggest untold story in finance today. The kind of story that, once you understand it, will change how you see the markets forever. Let's start with a staggering fact. Did you know that right now over 70% of all trades in the market are executed not by humans, but by algorithms? Many of these are increasingly driven by sophisticated AI. Think about that. The majority of the world's financial liquidity, the lifeblood of our economy, is being managed by code. These AI systems are designed for one thing: speed. They operate in microseconds, hunting for tiny price differences and executing millions of trades before a human can even blink. Their goal isn't to understand the real-world economy or to consider the long-term health of a company. Their goal is pure, ruthless optimization. They react to data patterns, not to fundamental value. Now here's where it gets truly dangerous. How do we train these AI models? We feed them historical market data. But there's a critical flaw in this process, a paradox that nobody seems to be talking about. The historical data we use to train these AIs comes from a time when markets were driven by human behavior. That data does not and cannot account for a market that is now dominated by other AIs. So what happens? We've created a massive global feedback loop. AIs are learning from market patterns that are in fact being created by other AIs. They're essentially chasing their own tails. It's like a room full of mirrors where every reflection is mistaken for a real person. This creates a dangerous echo chamber. When one AI model detects a slight downward trend and starts selling, other AIs see that selling activity as a new pattern. They interpret it as a signal to sell as well. And so on and so on. A tiny ripple becomes a tidal wave in seconds. The result is what experts call accelerated volatility. We see self-triggering market sell-offs and flash crashes that happen so fast that no human trader could ever intervene. Does this sound familiar? It should. Back in 2010, we had a taste of this. It was called the flash crash. A single algorithm-driven event caused the Dow Jones to plummet nearly 1,000 points in minutes, temporarily wiping out $1 trillion in market value. $1 trillion. Gone. Just like that. Now, here's the terrifying part. The algorithms that caused the 2010 flash crash were primitive compared to the AI we have today. We're talking about advanced machine learning and deep learning systems, all interconnected across global high-frequency trading networks. If a similar event happened today, the scale and speed of the collapse would be unimaginable. It wouldn't be confined to one market. It would cascade instantly across the entire global financial system, from New York to London to Tokyo, before anyone even knew what was happening. You might be thinking, surely the big banks and investment funds are aware of this, right? They have risk management departments. And you'd be right, they do. But here's the problem. They are all in an arms race. Every major financial institution, from Goldman Sachs to JP Morgan, is pouring billions into AI. They're using it for everything. Risk assessment, loan approvals, portfolio management, you name it. But in their rush to gain a competitive edge, they are unknowingly creating a new kind of systemic risk. They are all developing their AI models using similar data sets, similar optimization techniques, and similar goals. They are inadvertently teaching their AIs to think in the same way. This is a concept called behavioral synchronization. In the past, when markets faced a crisis, you had a diversity of human opinions. Some traders would panic and sell, others would see a buying opportunity, and others would wait and see. This human diversity acted as a natural shock absorber, cushioning the fall. But with AI, that diversity is disappearing. When a major market shock hits, If all these highly optimized, synchronized AI systems are fed the same negative signals, what do you think they'll do? They will all make the same decision at the same time: sell. They won't cushion the fall. They will amplify it, pushing the market off a cliff in unison. This is a risk that has never existed before in human history. Human traders have different perspectives, emotions, and reaction times. AIs, when trained on similar data, react identically and instantly. And it gets even worse. There's another massive blind spot. AI models are great at recognizing patterns from the past. But what are they terrible at? Predicting things they've never seen before. Black swan events, unprecedented geopolitical crises, sudden economic shifts, natural disasters. Things that don't exist in their training data. An AI trained on a century of market data would have no idea how to react to something truly novel. It would see the initial chaos, misinterpret the signals based on its flawed historical model, and likely make a catastrophic decision that worsens the crisis. The very technology we're relying on to predict risk is making the system more fragile by blinding us to new, unforeseen threats. So while everyone is talking about the incredible potential of AI, the world's largest financial institutions are building a digital house of cards. They are deploying these powerful systems without full regulatory stress testing against these new AI-specific risks. Regulators are years behind the technology. They're still trying to understand the rules of a game that has already fundamentally changed. If you're still watching this, I need you to hit that subscribe button right now. Because the information we share on this channel isn't just about finance, it's about understanding the hidden forces shaping our world. What we're exposing here could genuinely be the difference between being blindsided by the next crisis or seeing it coming long before everyone else. I want you to leave a comment below right now. Do you believe AI will be the trigger for the next major market collapse? Or do you think its benefits will ultimately prevent one? Let's get a real discussion going on this. Now, I promise to tell you what the insiders are doing. Hedge funds and even central banks are becoming acutely aware of this threat. They're not just talking about it, they're actively preparing. Some of the most sophisticated hedge funds are now running AI versus AI simulations. They are building adversarial AIs designed specifically to stress test their own models and hunt for these hidden feedback loops and synchronization risks. They're essentially wargaming a future AI-driven market crash to see how their systems would hold up. Central banks are quietly hiring data scientists and machine learning experts not just to build their own models, but to understand the systemic risks posed by the private sector's AI adoption. They are trying to figure out how to regulate a technology that is evolving faster than any law ever could. They're worried about algorithmic contagion and the potential for a crisis that monetary policy, like lowering interest rates, simply can't fix. What does this mean for you, the individual investor, or just a concerned citizen? It means you have to be more vigilant than ever. The old rules of investing are becoming obsolete. Understanding a company's balance sheet is still important, but it's no longer enough. You now have to understand that the market itself is becoming an unpredictable, AI-driven entity. It means that diversification is more critical than ever, not just across asset classes, but across assets that might be less susceptible to algorithmic manipulation. It means paying attention to the real economy, not just the dizzying short-term movements of the market. The greatest danger right now isn't a bad earnings report or a change in interest rates. It's the hidden risk of behavioral synchronization, a global financial system that is starting to think with one mind, a digital mind that has no common sense, no intuition, and no understanding of the real world it controls. This is the conversation we need to be having, not just in the boardrooms of Wall Street, but in our homes and communities. The future of our financial stability depends on it. Let's get even more precise. The risk from AI isn't just about some wild swings in the stock market. It's much deeper. It's embedded in the very DNA of our global banking systems, our lending frameworks, and even the models central banks use to forecast monetary policy. It's happening right now, behind the scenes. Think about the major global banks. They're all using sophisticated predictive AI tools to decide who gets a loan, how much risk to take on, and how to manage their massive portfolios. These AI systems determine your credit worthiness. They set exposure limits for entire industries, and they execute complex trading strategies in microseconds. On a calm day, this looks like hyper-efficiency. But what happens when the waters get choppy? Imagine a sudden shock to the system. It could be anything: a surprise interest rate hike, a sudden liquidity freeze like we saw in 2008, or a major disruption in energy supplies. When that happens, these AI systems, all trained on similar data and with similar objectives, could all react in the exact same way, at the exact same time. They could simultaneously downgrade entire sectors of the economy, pull back on lending, and tighten credit across the board. And they would do it all at machine speed, far faster than any human could react. When this coordinated pullback happens across dozens of major financial institutions at once, it creates a domino effect. Funding dries up instantly. Asset prices plummet. Panic spreads, not because of irrational human emotion, but because of cold, hard, rational model logic. It's a mechanical, automated panic executed with flawless speed and without a shred of hesitation. This isn't your grandfather's market crash. This is something new. What makes this even more dangerous is a fundamental weakness in these AI models. They are built on the assumption that the data they're trained on will remain relatively stable. They perform brilliantly when market trends are clear and predictable, but when the world changes overnight, they collapse. We saw this in early 2020. As the pandemic began, the models completely failed. They couldn't predict the economic impact of global shutdowns because nothing like it existed in their historical data. They were flying blind, and so were the institutions that relied on them. Now, fast forward to today. We're not just talking about predictive AI anymore. We're talking about generative AI, the same technology behind tools like ChatGPT, being integrated directly into trading strategies. This makes the risk exponential. Why? Because now, AI doesn't just react to the market, it actively shapes it. AI systems are now being used to generate financial news reports, create market forecasts, and even write the institutional research bulletins that land on traders' desks every morning. Imagine a scenario where these AI systems, all learning from each other, start to converge on a single narrative. They could subtly and unintentionally push a bearish or bullish view across the entire financial ecosystem. The system literally starts telling itself what to think. When everyone thinks the same thing, the natural buffer of diverse opinions disappears. This dramatically increases the risk of everyone trying to run for the exit at the same time. And what about the regulators, the people who are supposed to be watching over all of this? The truth is, they are years behind the technology. The adoption of AI in finance has been happening at lightning speed, while the regulatory frameworks are moving at a snail's pace. Banks all over the world are operating these powerful, complex AI systems at a massive scale with minimal, and I mean minimal, effective oversight. Behind closed doors, some central banks are starting to express quiet concerns. The IMF has issued stark warnings, stating that these digital trading models could massively accelerate the transmission of liquidity shocks. But you barely hear a peep about this in the mainstream financial media. It's too complex, too scary, and frankly, a lot of people don't even understand what's happening. But the big players do. The insiders know. Hedge funds like Citadel and Bridgewater, some of the most successful firms in the world, are already building their own private circuit breakers. These are internal defense mechanisms designed to protect them from sudden AI-driven market sell-offs. They're preparing for it because they anticipate that when these violent swings happen, it will be the retail investors and the smaller institutions who get wiped out first. They'll be the ones left holding the bag. If you've watched this far, it means you're not looking for the easy answers. So here's the key takeaway. The smartest move right now is not to be afraid of AI. The smartest move is to understand its limitations, to understand what it can't see. The real advantage in the markets of tomorrow will come from anticipating this behavioral convergence, this AI groupthink, and preparing your own liquidity buffers before the models force everyone else to. It's about being one step ahead of the machine. Here on this channel, we're dedicated to exposing the financial truths that mainstream analysts won't touch. We believe you have a right to know what's really driving the markets. So if you want to stay ahead of the curve, make sure you subscribe and turn on notifications. Because in our very next episode, we're going to break down exactly how AI could unintentionally trigger the next global financial crisis. We'll name the specific sectors that we believe are most at risk of imploding first. You won't want to miss it. Now, I want to hear from you. Drop a comment below and let me know what you think. Is AI the greatest innovation in the history of finance, or is it the most underestimated threat we've ever faced? The future of our markets might just depend on the answer to that question. Thanks for watching.